Good afternoon, ladies and gentlemen. It has come that time in which we will host our strategy meeting. We're going to have our great minds of briefing trader come together and talk about what we may be seeing over the course of the next month or so. So, we have had a big set of data points come to a crescendo here, and we've now got some central bank speak out of the way. We've got a big bulk of earnings out of the way as well. So I'm going to welcome in Brett Manning, aka Chart Trader, into the discussion and ask you, Brett, where do we stand in terms of the phase of the trend in the major indices now that we have been able to process all that data?
So first off, hopefully you can hear me. I just want to apologize. I lost my voice a couple mornings ago by screaming timeout so loud. For those of you who don't know, I have 4-year-old triplets, and I woke up at 6:30 in the morning, and they were standing in a flooded bathroom with an empty bottle of soap, giving baths to their stuffed animals. So I yelled timeout so loud I lost my voice, and that's just, as Jim, you said earlier to me, that's the joys of parenthood, which I'm finding out in a in a kind of panic here.
Hey, water's
But
okay. Fire is the
hey,
problem.
fire would have been a lot worse. But yeah, so as far as phase of trend, so the way I would look at this is we have reached sentiment extremes, and we've talked a lot about this. Gavin's talked a lot about this. We did a whole show on it, where we've reached sentiment extremes that are consistent historically with a more significant need for some more consolidative or corrective activity in the market to reset and rebalance toward a more normal market situation. But just because that's the case, that doesn't mean it has to happen. It can grow to a more extreme situation, certainly, and we've seen that at times in the past, and this very well may be one of those times. But, we saw hedging hit a 12-year low. We saw the AAII bull ratio 5-week moving average get to a decade-long high, and that's the type of festering phenomenon that I've talked about where you get vulnerability. We've seen record levels of calls bought, especially the robo ratio, smaller retail-only version. We've seen strategist sell-side recommendations at an 8-year high as far as percentage of capital that should be in the equity market. There's lots of other data points that confirm this. So there's a big spread of things that have all hit, multi-year or multi-decade kind of highs, and that's, I think, to some extent, it's a consequence of this being a very easy corner to see around historically, because coming out of the pandemic, it's really obvious to everybody that economic activity is going to pick up a lot. So, the degree to which that's priced into markets, that should be obvious that to some extent that's probably the case. But that explains why we see this type of sentiment data. It may be a little different from the sort of thing we saw in 2000 or in 1929, even though superficially the data points are very similar. It may be that this is a little bit unique because of that idea that it's a very easy corner to see around, that everybody has an easy time predicting that economic activity is going to pick up a lot, which would suggest higher sentiment in equities. That doesn't mean the market's going to go higher, but it also doesn't necessarily mean the market has to go lower. But it does mean that there needs to be some rebalancing or resetting moments. And, so when I was looking at when to look for a point of weakness to start shorting, I chose just after the mega caps report earnings and guidance. And that is something that's worked for me in the past. I would recommend it as a general strategy. It was amazing in February 2018. And the basic idea is nobody's going to sell ahead of monopolies talking about how they're doing, right? I think it's a simple way to look at the situation. Nobody's going to sell ahead of that. But as soon as you get past that, hey, what's the next very obvious point of good news? It's a little tougher to see. It may be July before we start to see really obvious good news again. So here's the point where you see some leverage come out of the system. But we saw a nice jolt of selling. We finally cracked out of 4170 yesterday in the S&P. However, as I said this morning pre-market, that may be it for this correction. I mean, we get these kinds of, you might call them pressure release valve days, where you cascade out stuff. You reset a bit in terms of weak hands and leverage and derivatives and hedging. just through a single sudden sharp drop, because it's like a cascade of a feedback loop that hits progressively larger weak-handed positions until you get to this kind of stabilization point. And if the fundamental context is powerful and positive enough, then one and done can be it. Now we've got people who have to chase on the higher highs because they just got kicked out of positions they liked. We probably got a lot more hedging than was there before yesterday because of some of the big names that went and the way that it was handled in the financial media, kind of throwing this taper talk around. It's possible today and tomorrow are going to be really important to see. In terms of how this pattern evolves right now, if it can just stabilize and move back to the highs, and we start to get that chasing from people who got kicked out. But let's just hypothetically say it was a one and done kind of pressure valve release day. Where do you look next? And I think where you might look next is really all the way out to like July and August for some potentially more significant topping risk. Because if you really look, so let's say the Q2 mega cap earnings streak, right? And then that's going to give way to August. And I think that we've got a lot of people with a pin in the calendar at Jackson Hole in August for the beginning of some kind of more substantive taper talk. And I think that this will be an important narrative here when finally we get to the point where the Fed's not sitting there just worried about equities. They're sitting there worried about getting enough momentum. I think there's a lot of people, whether right or not, that are going to be looking for that Jackson Hole point in August, and that's going to come just after probably the best quarter on a year-over-year comps basis since I don't know when, decades it has to be, because Q2 of this year with reopening with vaccinations compared to Q2 of last year, which was really the heart attack from the pandemic, the comps are just ridiculous. And there is going to be a lot of people who have a tough time selling in front of the prints on that. So if you keep this kind of festering, hyper-exuberant sentiment situation all the way through that point, and we get through the monopolies reporting in Q2 right in front of everybody looking for taper talk at Jackson Hole, that looks like to be what I would say is kind of the epicenter of risk to this trend, provided we're just moving past this and into the middle of Q2 and we see reinforcing good data and we start to get charged up about that next earnings streak. So I think that it's possible that it was a one and done that we saw yesterday. But again, today and tomorrow are going to be really important. If there's more work that has to be done, you want to watch the offer side and see if we start to see a lead blanket come in, because there's going to be some of that chasing already happening. And if some of those weak hands reestablish themselves right into a ceiling, we can start to shake it out again. And then yesterday's lows become a really important trigger.
So it sounds to me, Brett, like that sell and man go away is going to be the opposite this year.
I mean, again, if you look at the year-over-year relationship, it's last year was a very strange year. Now we've got comps to last year, so we've got a lot of leverage in the system. I mean, obviously, I don't have a crystal ball, but I could see that scenario playing out.
Yeah, and it does seem like we get those one and done days like you had just mentioned. So I think most likely we should be prepared to continue to see that buy the dip strategy all the way into that time frame that you mentioned, maybe the latter part of summer anyway. So I'm going to bring in event trader Gavin and want to get your take a little bit after what we saw yesterday. We heard Janet Yellen mention inflation. She didn't really talk it up completely, but we did see a component from the ISM survey. I believe it was the ISM today, Gavin. Have you had a chance to take a look at that and kind of comb through that? Because the prices paid index was among the highest levels since 2008, if I recall.
Yeah, I didn't see it for today's ISM, but that's been pretty commonplace with what we've been seeing, whether you're looking at consumer confidence, Michigan sentiment, the ISM in manufacturing, or the PMI. All have been talking up those rising input prices. Certainly been a common theme that we're seeing throughout a lot of the commentary for earnings. And we discussed that, how that was going to be the big test for the Fed, whether or not they could present an argument that this transitory rise in pricing pressures is what we're going to see, and that things would flatten out in the back part of the year, and that would allow them to continue on their monetary policy path, and they continue to stick by that. Obviously, we've had some a decent couple of numbers. We had some high CPI and PPI numbers there. PCE running a little stronger, but none of them has really suggested some sort of runaway inflation, at least in the reports. Certainly, anecdotally, I think you would get people suggesting otherwise when you're looking at housing prices, or even if you're just going to the supermarket or whatever it is, you might be used cars, another area that we're seeing those pressure points. But so far, we haven't seen it in hourly earnings. We really haven't seen it in wage growth. I mean, obviously, at the one-time pop from the stimulus bills that had an outsized impact on a few of the numbers here. But so right now, the Fed has done a good enough job to push its case on monetary policy. Now, obviously, Janet Yellen has yesterday with her comment, which I think, as I said, was taken out of context. Everybody saw the headline and ran with it, and that's why I wanted to listen to her conversation first before I commented on it. And when you take a look at it, it was really her just speaking as a general economist, and we know fiscal policies can put pressure on inflationary numbers. So again, this is something that we're going to watch play out. Now, I would probably be off a little bit with Brett's timing. Like, I could definitely see Jackson Hole potentially being a big issue in terms of a change in policy. I'll be really curious to see what goes on in the June meeting for the Fed. By that point, we would have had two more jobs numbers. We're getting one on Friday where we're expecting an increase of about 750,000 in the non-farm payroll. You had a little bit of a shortfall today in the ADP, so we'll see if that comes in light. But still, let's just say it's over 600,000, and we get an upward revision for the prior month, and then we get a big number in May. Then that could push the Fed's hand a little bit in the June meeting. So, it'll be worthwhile to keep an eye out on things and how we react to it. And certainly if we're running away with things going throughout the summer and just float higher, and there's another strong Q2 earnings season in that July to early August timeframe, we could definitely see a bit of a hiccup in September around that Jackson Hole. What I'm thinking of is we're going to see more of a chop over the next couple of months into the summer, into Q2 earnings, and then we're going to see things on the rise. A lot of this is going to be based around how we see the 10-year yield and yields in general moving. But I think one of the key things from yesterday was the idea that perhaps we don't get a taper tantrum this time around like we did in 2013 if people kind of detach from where the Fed's going and just start raising rates on their own. They're seeing a ton of issuance coming through from the fiscal policy, whatever it might be. But I'll be curious if the market prices in a taper tantrum ahead of any sort of action by the Fed, and then that turns into a non-event. So these are the big things that we're going to want to watch the next couple of months. But I would say this, I think it unequivocally the economic backdrop remains extremely strong right now. We're getting that reopening trade that is helping some of the industries that have been hurting. We just saw astronomical numbers from a lot of the big tech plays, and just in general the earnings reports. And I know that they are going up against some lower expectations, but they've been really strong. I think I saw that they are outpacing top and bottom line by something like 85%. Usually they're beating in that 70 to 73% range. So it's been a really strong earnings quarter. Guidance has not been as soft as I would have thought. I would have thought people kind of punted a little bit, but in general, we've been getting some upside guidance. And commentary around demand has certainly been strong. Now, we obviously have the supply disruptions that are going on. That should slowly work its way out into the back half of the year, which is, again, why I think that we see a strong back half of the year. But, right now we're just getting that pause where it just feels like there's no amount of good news that's going to really skyrocket us higher at this point, and that's why I think that I'm continuing to wait for a little bit more of choppier action, and not looking to sell on longer term items that I like, because I think that we do see a strong back half of the year. But for the next few weeks, I think we'll continue to see some chop.
All right, so I'm going to bring Brett back into the conversation, and Gavin had talked a little bit about interest rates, and I want to talk a little bit about the bond market, and more specifically where we are as far as the short interest is versus the upward pressure on rates.
Yeah, so I mean, this is something that we talked about, I think, last week and maybe the week before as well. That we are sitting in a situation where there is a decisive and powerful small speculator crowded short bet right now at the long end of the curve in the bond futures market, and that's something that it doesn't have to lead to a squeeze. In fact, I can go back through the charts and point out several instances where you have a similar situation and the bond market does not in any way squeeze. So I'm not suggesting that is necessarily a reason to buy something like TLT, but the risk is there. And if we see anything that moves in the direction of less of an upward pressure on long end rates, then the reaction would be dramatic. So it's a vulnerability for that trade, but there are tons of reasons for that in the first place. It's just as Gavin just said, we're outperforming even dramatic and foreseeable expectations for economic data, and the idea that we're going to see transitory inflation. Obviously, we're going to see headline inflation over the next few months. We're going to see numbers that resonate well with being short futures at the long end in the bond market. And we're starting to see talk from some of the people you might call really some of the market's most important missionaries in terms of wisdom in this moment and trying to figure out this difficult question. Somebody like Mohammed El-Arian, somebody like Warren Buffett, coming out and basically saying it's not going to be transitory. So you've got Powell's word and Yellen's word versus Mohammed El-Arian and Warren Buffett, who are kind of saying the opposite may be true. So the fact that we're sitting here with half-decade highs in short interest in something like ZN, the 10-year futures in the bond market, it's not surprising. And you can imagine that it's justified. And again, as I said, it can move in the direction everybody's predicting. That market is big enough, and it's global, and it's got a number of different points of flows that the futures market doesn't have to determine where that's headed. And there's real economic consequences to interest rates, and there's real participation from the economy in the interest rate markets. So it's possible. This isn't a small cap stock. It's possible that all those shorts are going to be right. And that's where the cycle would seem. I think particularly a day like yesterday would be the way to trigger that short, or that short squeeze. If we get a few days like that, because there's going to be some basic asset market, financial-based rotationary moves that happen if we start to see. So look at it this way. Everybody's long stocks and everybody's short bonds. That's where we are right now. If that bet on stocks starts to fail, so will the bet on bonds. That's how you get the squeeze. So if Gavin's right, and I'm very agnostic about the situation, and I don't mean to say it that way, Gavin. I know you're somewhat agnostic about it, but you're looking for more downside despite what happens today, I think. And I can certainly see that. If we run into a situation where we get a lead blanket offer, we get some of these weak hands chasing back into stocks, and they just run into a wall, and we start to peel this off, perhaps the breakout in the Dow that we talked about this morning just is a spike higher. It runs some stops, it rolls back over. If we start to move anywhere near yesterday's lows in the next few days, then this has the character of a 1 degree out type of correction. That's how you're going to spark that squeeze in the bond market. I'm telling you right now. So that's I think the trigger is probably more about asset class rotation. It's probably more about diversified macro fund exposure than it is necessarily about a long-range view on whether or not the inflation is going to be transitory or not. I think it's going to be exposure related, and you can trigger it, and it can be a great time to short bonds. I think on the other side of a squeeze like that, if we can get that kind of shakeout to the upside, would really provide an opportunity, because I think the larger time frame picture is relatively clear.
So does that mean you're going to be eyeballing the bond futures again, Brett?
I would like to see a squeeze there to position myself short.
All right.
Hey, Brett, let me ask you this. How much of that squeeze potential and positioning do you think plays into the Fed's monetary policy?
I get where you're going, and
Yeah.
maybe there was a conversation like that. I can't imagine that that's too material. But again, we'll never know the answer to that question. They are smart people. It would take the pressure off, but to some extent, look, the interest rate move higher has been good for them a little bit, right? Because, I mean, what's one of the things they really wanted a few months ago when we were in February, and you had some of the speculation and the more speculative side of the market really becoming something that highlighted the idea that they were fomenting a bubble, and the little spike in interest rates, tanking some of the ARK funds, tanking some of the ARK side of the market was probably something that just worked perfectly for them. So, it's also been useful in terms of the type of market-based conjecturing and game theory you're talking about. I think that both sides of that equation work equally well for them. But I don't know the degree to which they're looking at that as a safety net, if that's what you're implying.
Yeah, no, I was just wondering because, I mean, obviously, when they're talking financial conditions, it's something that I would think, would be paying attention to and, cognizant of their moves doing that. I mean, you saw Yellen walk back and, as Carmine said, doing her cleanup in aisle 3 after her comments, and they're very cognizant of trying not to upset that. We see
I think
Evans and Mester out today kind of doubling down on that.
I guess I think that kind of thinking you're talking about is a bit like the little old lady who swallowed a spider to swallow the fly. I don't know if that's a rabbit hole with collateral consequences to think in terms of real strategy that way,
Right.
but it's possible.
All right, so this gives me an avenue to bring in Damon, aka Scalp Trader, and Damon, you've been awfully quiet. You've traded here and there a little bit, but your activity level has quieted down. What's going on over on your front?
So I mean, we've all been doing this a really long time, and I've learned the hard lessons over the years of not recognizing when the music has slowed and continuing to trade as if the market was still hot. I've learned that lesson, and now I'm recognizing that it's time to be more cautious, more careful, protect capital. You could really get yourself. We're coming off a really good year this past year, and it just doesn't make sense to give back profits. And I think the change in the market conditions, the lower volatility, the tighter intraday ranges just warrant just being cautious right now. Volatility will return. There's going to be opportunity to make money at some point again, lots of money. So for right now, I'm really just going in looking for short-term intraday scalps, waiting for pullbacks to initiate or add to swing positions. But just taking a very cautious approach because there's just no reason to be aggressive at this time.
So you've been really good about finding some areas where there's a lot of money to be made, whether it's in distressed names. For a while it was in those cryptos. Lately it was in the SPACs. So I want to know, what are you doing your homework on?
And it's interesting. I mean, everything, I usually have something going, right? Like some new area that I'm researching that's out of favor or relatively new market segment. And there's just not a lot right now. I mean, I think to me, still very compelling opportunity in the SPAC universe. SPACs are really out of favor right now, which is something that I like, right? companies that are announcing SPAC transactions, the stocks really aren't doing anything the first day. So you have the opportunity to buy both the common and the warrant. So, so there's an opportunity to buy warrants on these names for $1 to $1.50 after the deal is announced, 5-year warrants. And so I'm just going to continue to just watch the SPAC market, look for opportunities. I mean, you see, I mentioned Playboy earlier today. I mean, that's a recent SPAC that broke out to new all-time highs today, hit $60. I mean, this was trading at 12, 13 a couple months ago. Another one, MUDS, MUDS, trading at all-time highs today, above 18. So there still are some SPACs that are working. Just really important to be selective. And I'm just going to keep sifting through them, looking for the compelling opportunities, see if I can buy some warrants for $1 and ride if stock goes to 30, those warrants might go from $1 to $12, $15 plus. So I think the patience will pay off, but it's just really a matter of just sitting there and looking at every deal, just trying to find the compelling opportunities.
And it's probably safe to say that you will be recycling some of your old names that you've been. I mean, that's pretty much your MO on a daily basis. So names that you're really comfortable with, and then you see something where it just seems this might be too much of a move lower, and you jump right in. So keep all those names fresh on the radar, right?
Yeah, so most of these names I have kind of a fundamental view on, and names that I want to own for longer term. So I think today, STEM, I reinitiated a small swing position in this one. It's one I want to own long term. Been waiting for it to pull back and waiting and waiting. I still think that we could see a move lower in this name and in the market in general, especially the momentum names in particular. Could see some type of flush in those names. So I started at a quarter size in this, hoping to be able to just accumulate it at lower prices and then be there for the next strong move higher. So that's where I am. Usually between I either have something on the radar because I like it from a fundamental perspective, or it's going onto my radar because of the increase in recent volatility. So in the expanded trading range, a lot of momentum money, shorts trying to push it back down. And so I try to, especially on a short-term intraday basis, those are kind of the two types of stocks that I really pay attention to.
All right. You mentioned a couple of names that Craig, aka Trend Tracker, follows very, very closely, that being Playboy and MUDs. In fact, I think you still own those, don't you, Craig?
I'm out of Playboy, unfortunately. I did sell that one, I don't know, maybe about a month ago. That thing has just been a beast. It's, I guess it's not a coincidence that the two SPACs that are hitting new highs that are still working are NFT plays, which brings us back to crypto. We've been talking about that NFT space for a few months now, and I was fortunate to get good entries in both of those. I have a very small position left in MUDs, and Playboy, has just become this momentum stock. So I'm out of Playboy, but I still have a small position in MUDs.
Okay.
Which is Tops, the baseball card company, but they also have a confectionery candy business.
Yeah, with that old stale gum. I know it well. Anyway, so you have been the epitome of stock picking lately, Craig. What's your secret? What's going on in the lab back there? And then talk to us a little bit about your new ad. I think it was Upwork today. So let's start about what you're working on.
Yeah, so it's been a pretty good month or two. I've just been trying to stay disciplined and selective. The high multiple secular growth stocks remain out of favor. Valuations matter again. We've seen countless sell the news reactions to strong reports. It's easy to say that a lot of the good news has been priced in. But there's still opportunity. I'm just trying to stay selective. As Damon noted, by staying patient, I'm getting good entries. I wrote up my entry yesterday in Penn National was a good one. I mentioned it Monday morning, and I was tempted to jump in. Luckily, I got a much better entry by waiting a day. They report tomorrow, but it's an example of a more cyclical, traditional U.S. consumer company. It's they have actual casinos. It's not a 10, 20 times sales stock. The Barstool acquisition last year allows them to acquire customers at a much lower rate, but essentially this is an old school casino business that's trading at a reasonable valuation. It hasn't paid at all over the last few weeks to be trying to play earnings on these high multiple stocks. Upwork is the latest example this morning. It was hard to poke any holes in the report, but clearly we're seeing some profit taking. I don't know if it's just concerns about compares going forward. I think maybe even the labor news that was weighing on Uber and Lyft is kind of affecting them. I don't know. I suppose that Uber and Upwork and Fiverr, which is the peer, FVRR, they're both contract work platforms, so they sort of get lumped in with the headlines that weigh on, labor issues when it comes to the gig economy workers. But these are more of the traditional freelance markets. So I think that any weakness related to that is, I don't really know if that's affecting it, but I don't think it should. But as we've seen in recent weeks, it hasn't really mattered how good earnings have been. Everybody's doing great in Q1, and they will in Q2, given the easy compares. But are these blowouts really sustainable? Something like Apple, who had a massive quarter with Macs and iPads and the iPhone. The iPhone super cycle seems like it's happening, but really there's just tough compares going forward for the other businesses. And the multiple has pretty much doubled over the last year and a half, 2 years. So, you can say the same thing about the broader market. Everything is great, but if earnings growth is peaking, then it's easy to say, well, the good news has been priced in. So we're seeing a lot of earnings can often act as just liquidity events. So no matter how good they are, depending on the multiple and the risk reward, we've seen a lot of profit taking. So I've just tried to tread lightly and pick my spots.
All right. And as far as anything that you're really looking at, is any names that are jumping off the page for you that you are potentially dabbling in? Anything new?
Well, Penn was my new one yesterday. This stock is well off its highs, and it is trading at a low to mid-teen EBITDA multiple. So it's more of a cyclical play, which obviously the cyclical stocks continue to work. Brett pointed out that as ugly as it was in the NASDAQ yesterday, the Dow hit a new high again today. I'm seeing the other major sector ETF I'm seeing with hitting a new high today is metals and mining, the XME. Energy is on fire. Those ETFs are up like 3 to 5% today. So, the cyclical stocks continue to work. So I'm trying to dabble more in those areas where the valuations are more reasonable, like a PENN. I'm still in Golden Nugget Online Gaming, which is just a pure play online casino. I'm pretty much flat. It's trading at basically where I bought it last year. I've taken profits on the way up, but I think it makes more sense to own PENN here because its core casino business is on fire. They also have the Barstool kind of kicker to it. But there's a lot of high multiple growth stocks, here that are going to report. Cloudflare this afternoon, which is a net, and Twilio, TWLO. These are two of the elite cloud stocks, or what I refer to as some of the elite ones that are trading at premium valuations. So, it hasn't worked to chase those. But something like Twilio now has kind of pulled back toward the low end of its recent range. It got close to the 200-day yesterday. So it'll be interesting to see if the risk reward has improved enough on this little shakeout. Maybe it will be able to rally, but trying to see here. Twilio's trading at 23 times sales. Actually, I think it's Fastly that's this afternoon, which is another CDN sort of peer of Cloudflare. Fastly is one that I bought, was it late 2019 or early last year? Wrote it, I exited. It went on to rally a lot further after I exited, but now the multiple is down close to, I think it's even under 20 times sales. It was trading over 40 times sales, I think maybe even in February. So this is one where now expectations are actually kind of low because the market has determined that Fastly really isn't at the caliber that Cloudflare is. Cloudflare is one of the most expensive stocks on that I can find. It's like 40 times sales. So Fastly at 18 times sales looks pretty cheap, but obviously there are reasons why Fastly has pulled back significantly and Cloudflare remains toward the highs. So there's going to be trading opportunities in these cloud stocks, of course, around earnings season. But so far, just trying to play beats and raises has just been a losing strategy because a lot of the strength has kind of been priced in. So yeah, we'll just keep looking out for movers in that respect.
All right, I'm going to shift gears a little bit and talk about markets that we don't normally, and that is the commodity market. So I'm going to bring in Brett Manning and talk a little bit about the commodity rotation and whether or not this is going to prompt him into trading something like grains or maybe a little more oil. Brett, what are your thoughts on this?
So, all right. So, I probably not grains. I know that's you like the grains, Jim. It's not my forte. I'd say metals and energies more so, but I see the same thing, and I'm not sure if the reasons are the same. But I understand the industrial metal space, and I understand particularly crude oil in terms of energies. I think there's a phenomenon going on. And I just want to kind of reinforce. It's something we've talked about, but it's important to reinforce why this is happening. And so so you're seeing effectively evidence of the time lag, which is built into commodity markets, which go through boom bust cycles. Like you can look at commodities as really distinct from equities. The idea of a commodities ETF, for instance, while it's going to be hot right now, it's a little bit silly over the very long term because commodities can't really grow. So commodity stocks are a different thing, but I mean the commodities themselves. So the prices are going to oscillate over time, and they're not going to just go up, or else something is broken. So, but it's about supply and demand. And last year was such a remarkably strange phenomenon, and particularly let's say the 6, 8, 10 months that followed the big bust. If you look at oil as kind of a good test tube case study, the crash in oil that happened in April was a traumatic event in that market where we saw prices go down to negative $40 a barrel. And that was basically there's so much oil, we don't know what we're going to do with it. You now have to pay us to hold your oil because we'll never need oil again because we're going to stay in lockdowns forever. The end of the world is here. And that process, we got to September and October, and you still had no investment in really reopening oil production and really expanding, let's say, like rig count, or doing anything even kind of like exploration for new oil, right? Because we're headed into cold and flu season. We don't know if a vaccine's going to work. We don't know if it's going to be approved. We're just going to be in more lockdowns in February. Why would I put my money in this? And so that paused everything for a long enough period of time. It takes time to reopen this stuff. You can't just, it's not just flipping a switch. With some of the shale players, it's a little tiny bit like that, but on a big global basis, as far as the oil market is concerned, and especially when it comes to finishing off projects where you've started an investment in developing new production capacity, but you have to sink more money, more time, more energy, more people into turning that into something that's producing any amount of oil that's really going to impact things. Demand for oil goes up over time. It's still increasing. It's going to increase for another maybe 10 years. And that's despite the trend in electric vehicles. It's still going to increase. And if you go a whole year without increasing production capacity, that's got a 3-year lag that's going to hit things. And then you don't even reopen fast enough to where we're headed into summer driving season, a critical threshold of possible vaccine-induced herd immunity in the developed world right around the corner, and a massive need to travel. People haven't seen their families. They haven't gone away on vacation for a year and a half plus. This is all about to hit. And the infrastructure bill coming through, monetary policy being set on the easiest it could possibly be, the invention of the great age of fiscal policy around the world generally, like that's all coming together, and it's lighting a fire into these things, and I think for good reason. It's just basic supply and demand. I don't think that the sort of the game theory landscape of investing, because of the time lag, people are getting excited about commodities right now, but not investing in production of commodities, at least not far enough in the past to provide for a situation where supply is going to be able to keep up with the increase in demand in lots of these different markets. And I think oil is a good one. So I remain bullish on oil, and I've been long it a few times here and there over the last, say 6 to 8 months. And I would be willing to move back into it, particularly on the right type of technical setup. But I think that you're going to see, I think we're primed to see OPEC continue to punt a little bit, or at least to have the pressure to punt because of what we're seeing in like places like Brazil and India. But the big demand for energy, and the countries that have the largest demand for energy are reopening faster and faster. And I think that you've got a time lag problem. You have a fundamental time lag problem. It isn't just about realizing that you need more oil, or realizing that you need more copper, or realizing that you need more whatever. It's about, once you realize that, it's going to take you several months to create a situation where that's going to happen. And if we are facing a situation where the demand is set to spike faster than that, and these markets are already tight, I think that's what you're seeing right now. And it's one of the reasons why we're seeing this rotation out of tech. It's not just because we have some of these plays in tech that have maybe overpriced, and it's not just the end of work from home. I think it's just a more compelling opportunity.
All right, and Gavin, you have already dabbled in the commodity market a little bit with your positions in the XME and VLO. You want to talk about that a little bit?
Yeah, I mean, XME was one of the plays at the beginning of the year was bubbling up pretty nice when we were looking at back at that 35, 36 area, and it was just kind of chopping around in there, and was looking at the potential for the infrastructure projects coming through once that Georgia election kind of fell into place. I know that was something that Brett had talked a lot about, where it was going to be easier for them to push some of the policies through. And the miners were just a nice valuation, so got into that, and it's just been a nice steady upward trend. And we're looking at the market shop around, but this one's just breaking above 42 and extending above its break. So the XME looks great up here, and I think it's got some further scale to run, especially if you're starting to look at inflation. And then for Valero, this is a summer driving play for me. The chart was looking good, getting back above that 50-day moving average here. And I just think in talking with people, everybody's ready to kind of get out. Not everybody's ready to go fly someplace and things like that, but they are ready to go travel and do a few things. We've seen the RV plays certainly talking about the amount of demand that they're seeing there. So I just think refiners in this environment should have a pretty good couple of quarters. And that's why I've been looking in that space. And then the other areas that I'm just keeping an eye out on is the semiconductors. Is they're getting hit on news, but I think the fundamental backdrop still provides a runway for valuation that's going to be there for a few quarters. They got multiple quarters of demand laying out. So being patient with those while I'm being a little bit more aggressive on the cyclical side, and that's kind of how I'm playing things right now.
Okay, gentlemen, I think that's going to wrap up this edition of our trader strategy meeting, this one for May, and sounds like the overall takeaway would be opportunistic and be patient. I think that's the overall takeaway, unless there's any objections from our crew out there. I will bid you all adieu, and we'll be looking forward to talking to you guys next month, and we'll do this all again. Thanks a lot for joining us, guys.
Yeah, thanks, Sean.
Hey,
All right,
thanks,
we'll
Jim.
talk to you soon. Thanks.